This is a discussion about the accounting concept of expenses, and we'll have this discussion in the context of service businesses. Service businesses are those that generate their revenue and hence their profits by providing services to their customers. Here are some examples. A courier service, a dentist, a trainer, a personal trainer, a bricklayer, a tree lopper, a podiatrist. All of these businesses are service businesses. They generate their revenue and hence help generate their profits by providing services to their customers. We'll use an example of a service business called Annie the Architect. This business provides a service to clients about architectural matters. So this business generates its revenue by providing advice, architectural advice, to the clients. On the left we see an example of an income statement for July 2019. This business has generated $10,000 revenue, but you'll see highlighted in white are the expenses that have been incurred over this same reporting period, over July. Expenses of wages, $900, internet expenses, $300, rent, $4,500, and cleaning expenses, $200. Total expenses, $5,900. What are expenses? A very simple definition would be this. Expenses are incurred to help the business earn revenue, and expenses work to decrease profit. If these expenses were higher, the profit would be lower. So there is this inverse relationship between expenses and profit. If we increase our expenses, we decrease our profit. If we decrease our expenses, we increase our profit. Profit belongs to the owner. So there's going to be a relationship between the profit generated by the business over the reporting period and owner's equity. Profit will be transferred to the balance sheet and added to owner's equity to show that profit increases owner's equity. If expenses are high, relatively high, profit is relatively low. That will lead to a decreasing effect on owner's equity. If expenses are relatively low, then profit is relatively high, and that will have a positive effect on owner's equity. So expenses work to decrease profit. Profit belongs to the owner, so expenses tend to reduce owner's equity. Let's have a look at a simple definition of expenses. Expenses are transactions that lead to a decrease in owner's equity, excluding drawings. Here's an example. Paid wages $900. This would lead to a decrease in assets, $900, and it would also cause a decrease in owner's equity of $900 because it is an expense, and wages expense would reduce owner's equity. So it is a transaction that leads to a decrease in owner's equity. Paying wages decreases assets, and it also decreases owner's equity. Here is a more comprehensive definition of expenses. A decrease in an asset or an increase in a liability that leads to a decrease in owner's equity, excluding drawings. Let's look at the same example as before. Paid wages $900. That would lead to a decrease in the cash asset, $900. So the first part of the definition has been met, that is, a decrease in an asset. And as we have seen, it also leads to a decrease in owner's equity, $900 because of the wages expense. So it does meet the definition of an expense. It's a decrease in an asset which has led to a decrease in owner's equity. It's not drawings, so it does fit the definition of expenses, a decrease in an asset or an increase in a liability that leads to a decrease in owner's equity, excluding drawings. Come back and see video number 2.